Hi all, and welcome to this presentation with Tethys Oil. My name is Carl Fredrik Pedersen. I'm covering Tethys Oil from ABG. Presenting on behalf of Tethys Oil today is the CFO, Petter Gjersted. So without further ado, Petter, the floor is yours.
Thank you, Carl Fredrik. So today I have the pleasure of presenting Tethys Oil, an Oman-focused, debt-free, dividend-paying E&P company with focus on exploration, but with 11,300 barrels per day of production. And we have 5 blocks covering 50,000 square kilometers onshore in the Sultanate of Oman. Here's some quick facts over the company. We've been around since 2001. We're listed on the Stockholm Exchange, have a market cap of just above $200 million, almost $60 million in cash in the balance sheet, no debt, free cash flow positive for the first 9 months of the year, and 27 million barrels of 2P reserves, and a further 14 million barrels almost of contingent resources, all in our blocks onshore in Oman. So the core area is, since over 10 years, the Sultanate of Oman on the Arabian Peninsula. We have been there for 10 years. We have production experience, we have exploration experience, and we hold an interest in 4 different EPSAs, that is exploration and production sharing agreements, of which 1 is in production and 3 others in the exploration phase. And the combined license area is corresponding to about 18% of the area of the Sultanate. Here's a map of the various concessions in the country. It is a very diverse group of oil companies active in the country. Everything from the majors such as Shell, BP, Eni, but also it's also a country friendly to smaller and junior companies such as Tethys. So it's a very open environment and one of the few in the region that is open to companies of all sizes. So a bit more about Oman. It is on the tip of the Arabian Peninsula, outside the Persian Gulf, and has a production of about 1 million barrels per day. Is not a member of OPEC, but an active member of OPEC Plus, and it is a very open environment for companies such as ourselves. We have our 4 licenses, blocks 3 and 4, where we have 30% non-operator. It's a production and license until 2040. And then we have our 3 exploration licenses, block 49, where we have just early this year drilled our first exploration well, completing the commitments of the first exploration period. And there we partner with the American onshore company EOG Resources. On Block 56, we are operators since earlier this year, and partners with a group including the 2 local players and the Indonesian conglomerate Medco. That's in its second period. And Block 58, we're in early stages. We're 100% interest holder and operator. Blocks 3 and 4 has really been the foundation of Tethys Oil's operations in Oman. It's been in production since 2010 and has had a production in excess of 13,000 barrels per day net to Tethys before limitations, currently around 11,000 barrels per day. It's a light sweet crude, 39 degrees API, and currently have full activity on the blocks with 3 rigs actively drilling, actively shooting seismic, and exploring and developing simultaneously. We're also looking to utilize the gas, associated gas produced and for power generation on the block. So a full scope project going on. Block 49, where we, as I said earlier, we drilled the first well, first exploration well earlier this year, the Thameen well. We encountered hydrocarbons, but no flow rates were established. And after extensive analysis, we have concluded that it's most likely low permeability leading to a very tight reservoir and will need further stimulation to flow. And currently we are in negotiations or discussions with both the government and our partner EOG on next steps on how to pursue the most likely unconventional potential of the block. We farmed out to EOG earlier this year and got the exploration well carried, and we now look forward to the next phase of most likely unconventional exploration together with a expert in the field. Block 56 is a block with a variety of opportunities geologically. We are currently preparing to start drilling a 3-well program on an area called Al-Jumd, where there has been extensive drilling and 3D seismic shot in the past. We see a potential of potentially establishing the commerciality of a number of leads and prospects in that area, starting with these 3 leads, and beyond that there are further 10. We see a good potential of that coming to development quite quickly if commerciality can be established. Aside from that, there is the central portion of the block, which we are currently shooting seismic or about to start shooting seismic, and which will most likely lead to drilling in the years to come. These are areas completely geologically independent of each other and shows the diversity of opportunity on the block. Block 58, we signed the license middle of last year in the middle of the pandemic. We have 100% license interest. It's located to the south of Block 49 and the sort of southwestern part of the country, on the edge of the major block in the country, Block 6, which is held by the semi-state-owned PDO, and moves into that South Oman Salt Basin, which has been very prolific for PDO, and in an area that is new to us but very familiar for Omani petroleum geology. There is plenty of data on the block, and we have 2 identified leads, and some already covered by 3D seismic, and one where we intend to shoot further 3D seismic to mature a prospect. Just some quick financial highlights from the past quarter. You can see we had free cash flow of $13 million, an achieved oil price of almost $67 per barrel, and an OPEX around $10 per barrel, and the average daily production of about 11,300. The achieved oil price reflects not the full potential of the oil, the spot price in the period, due to a lag in the pricing, 2-month lag in the pricing of oil sales out of Oman. So the higher oil prices we've seen during Q3 and Q4 will be realized with a few months delay. But still very healthy financials on base of good production and good oil prices. And our balance sheet is boringly solid, no debt, plenty of cash, and a strong equity position. And this is despite actually distributing almost $16 million to shareholders earlier this year. So a good capacity to invest in our blocks, good capacity to distribute cash to shareholders, and still have a very solid balance sheet. So, in conclusion, the investment case, I mean, we have a company with a strong production base, with very favorable terms in all our licenses across both production and exploration. With robust cash generation of $20 million year to date, cash balance of almost $60 million. We've been paying a dividend since 2015. It's something we certainly strive to continue to. We have a very active work program across all our blocks with production drilling, exploration drilling, seismic, and plenty of news in the year to come, and plenty of activity that should be value creative. And we also have some exciting non-conventional potential on Block 49, which is a bit out of the ordinary for this part of the world, but certainly something we're very excited to be part of. And in this coming quarter, in this current quarter, or maybe even earlier next year, we expect to start our own drilling campaign on Block 56 to unlock the commercial potential of that Al-Jumd trend. And with that, I want to hand it back to you, Carl Fredrik.
Thank you, Peter. I'll kick off with a set of questions. So if we could start off with production and Oman being partly limited in terms of production due to its affiliation with OPEC Plus. Your production has been very stable, but it has not grown as OPEC Plus has been allowed to increase production levels. How is the relationship there, or how does it work when OPEC Plus is easing the production cuts? Why doesn't that feed into your production numbers on a monthly basis?
That's a very good question, Carl Fredrik. I would say that the main consequence of OPEC Plus, apart from the very sharp drop in production back in 2020, was that we were put in a position where we essentially had to cut back investments significantly to be able to preserve the cash flow of the project. And that investment, of course, has remained low for a very long time, from mid Q2 of 2020, essentially through to almost mid-year of this year. And as that investment activity is now coming back and picking up again, well, only then can we see production coming back. So we have seen actually quite a lot of production coming on the back of what is essentially quite low investment for that block. So we expect investments to continue ramping up towards the end of this year and potentially even next year, and we should see the results in that in due course. But it is very much a function of investments.
And yesterday you published the production levels for October, which was down a fairly substantial amount relative to September. Is that kind of a temporary effect for that month only, or is it a reflection of?
Yeah, I think we guided in conjunction with the Q3 report that we expect production for the year to be at about 11,100 barrels per day. And we ended the third quarter with 11,300 about. So clearly we are expecting a lower level during Q4, and that is in part the effect of this lower investment not yet materializing in production, and also some temporary difficulties in terms of the water handling and the changes in sort of shift in operations on the block as we ramp up. So we expect that to be overcome, coming back to sort of the levels previously seen quite soon, but growth will have to wait a bit further.
Oh, makes sense. And then historically, you have been able to, on a continuous basis, add more reserves to your reserve base, meaning that you have identified more volumes than what you have drilled and produced. What would this look like going forward? Do you have kind of, I guess, as volumes are at high levels, it's harder and harder to maintain a positive reserve replacement ratio. How should we think about that for the coming years? How confident are you in continuing to grow the reserve base?
Well, naturally, it always becomes more challenging as the comparative base grows. So having had that very strong track record for many years, we're very proud of that, but we do realize it does become increasingly challenging as the numbers become higher and the block matures. But I would say there's always been a multitude of sources boosting those reserves. I mean, it's everything from exploration leading to new discoveries, adding new reserves, but also in no small part, I mean, the performance of the existing fields has been a very important factor, and we continue to see a number of our fields continually performing better than expected. So I'm quite confident that over the years to come, we will continue to see very positive reserve replacement. But where exactly it will come from one year to the other, that's difficult to predict. And but we certainly see very good performance in many of our fields. We see lots of potential still on the blocks. We are coming back to full investment and full capacity in operations. We certainly see a good chance of unlocking that exploration potential in the years to come. The exact timing of which is sometimes difficult to predict, but I see no reason to be less confident in the long-term reserve trend for the license.
Then, before we move over to the balance sheet, drilling on block 56, which is planned to commence now in Q4, I guess. We are in Q4, so hopefully it's right around the corner. Will you announce the spudding of the well, and exactly what should we, from the outside, be looking for? What would be a positive result?
Well, it remains to be seen if and when we announce the spudding of that first well. But I would say that these are two of these wells are essentially appraisal wells on known discoveries where the commerciality of the discovery is yet to be established, and I think that's the key here. It's about establishing flow rates and being sure that we can achieve sufficient flows from these fields to motivate what essentially would be a fairly light, small-scale development. While as we announced in our Q3, the three prospects on a gross basis hold approximately 7 million barrels of resources. We see that the value of those barrels is very high, and they're accessible because of the shallow reservoir and the ease of being able to drill and develop that. But that is assuming we can get sufficient flow rates with the kind of drilling we expect to do. So I think that's the key to look for.
And if you are successful on block 56 in this exploration drilling, is this and given that it's a moderate-sized discovery, is this an area which it's possible to, for example, truck the oil out of, or would it require infrastructure investments in pipes, for example?
Most likely, we would be able to truck the oil. It is very close to infrastructure. It's close to other producing fields of a similar nature. It's close to some of the main pipelines. And it's this low threshold that also makes it very attractive. And given that there is a large number of follow-on leads that could, if they work, be hooked up to the same production infrastructure, we see a very good potential of perhaps developing this as a small cluster that can utilize existing infrastructure in nearby blocks and in nearby area.
And then to your balance sheet, you don't have any debt, and still, when COVID-19 hit, you scaled back substantially on investments. How should we think about kind of the capital allocation priorities? Is it so that you will maintain a very strong balance sheet? You call it a boringly strong balance sheet, or is it so that you will use it to do counter-cyclical investments? Or will you do pro-cyclical investments? Or will you increase the distributions? Or will you do transactions?
I would love to do all of the above, but it all comes down to opportunity and also the where we see the most value being created. And we're actually in a position of luxury where we feel we're not that sensitive to the short-term oil price fluctuations. So we see with our now expanded portfolio of exploration licenses that we can confidently plan quite extensive exploration on these, which we see as very value creative, irrespective of the oil price climate the coming 3, 4, 5 years. At the same time, we can maintain a very attractive dividend to our shareholders on the back of the production from blocks 3 and 4, and this gives us just a very different planning horizon. Now, we do expect to put the money at work. We currently see a cash position that perhaps we hadn't expected if you'd asked us a year ago, simply by virtue of the oil price being that much stronger. And equally, we would have expected perhaps some of the spending to have picked up a bit faster during the 2021. And that has resulted in that we have a slightly higher than expected cash balance than we expected a year ago. But we certainly have no lack of projects or either to spend on, and while also being able to clearly prioritize the shareholders' desire for more dividends and return.
And what drove the slower than expected ramp up in capex? Was that the lack of projects, or was it all of the limitation that has been imposed on us due to COVID-19?
I would say it's mainly a function of operating under restrictions for a long period. It means that simply getting things working in the field with quite strict sort of anti-COVID infection regimes can become quite cumbersome. There have been outbreaks on rigs and which have all been had no serious consequences for any of the involved, but it does mean that you have to halt operations for a short while and ensure that there's no further transmission and equally that at the same time, we've also seen a lot of other players picking up activity, so the demand for a lot of these services has also been very high and higher than perhaps we would have expected. So securing rigs, securing seismic crews has been quite challenging because activity in the country is picking up, and we are not the only ones seeing the potential and opportunity in Oman. So investment is certainly.
Is that due to prices, or is it due to securing rigs and securing crews? Is that a matter of pricing, or is it a matter of the absolute availability?
Well, we're always looking to secure a good price, and we won't take any rig or any crew at any price. So there's always a question of negotiations. But ultimately, yes, there is a limitation. And we see this. This is an industry that perhaps hasn't received the total investment in the past few years that it could carry, and that does create some bottlenecks in certain portions of it. So yeah, that is at least in the shorter term a limitation. In the longer term, that usually evens out. But yes, when we're trying to ramp up quickly, that becomes a clear limitation.
Yeah. We are running out of time, so I'll finish up with one or two last questions. Just to make sure, have you secured now all of the infrastructure and people that you need in order to execute on your budget for capex for 2022?
I believe so. I believe so. We and that's the beauty of having several licenses as opposed to the situation where we were just a couple of years ago when we only had one operated license. We now can secure contracts that span more work over several licenses, and that does make us a more attractive buyer of services, and it puts us in a better negotiating position. So yes, we feel confident that we have secured all the necessary resources. Okay,
excellent. So the upcoming main trigger is the drilling of on block 56 of Al Yumda, and beyond that, it's ongoing operations. And I guess from our end, we look forward to follow you. And thank you so much for the presentation, Petter.
Thank you, Carl Fredrik. Thank you.
Have a good day.